you don't master catching trades that have at least a double-digit risk-to-reward ratio profile consistently, you are always going to be slaves to your charts. You're always going to be thinking that you need to be putting more positions on. And most importantly, it's always going to take you a really long time to pass funded challenges and even get to really hefty payouts that can actually change your life. So in this video, I'm going to show you the three-step process that I use consistently to identify and catch at least 1 to 10 risk to reward ratio trades. And I promise you, by the end of this video, if you apply what I'm showing you, you will not only pass challenges faster, but you'll spend less time on the charts and you will make more money. Let's get right into it. So step one of this process is actually the easiest for Forex traders to master once they understand some of the rules, and that is to identify your higher time frame structure. Okay, so step one is identify higher time frame. We're going to use TF structure. Okay, now that's the very first part. Now, the first thing that a lot of traders struggle with is actually identifying what structure really is, or having a rule-based approach to identifying structure. So I want to show you how you can identify structure really easily. Okay, now you may have been taught before that structure in the market is just when the market gives you a high to a low and then a lower high and a lower low, or you know, the bullish example, which is the market giving you a low to a high, then a higher low, and then a higher high. And that is actually accurate, but I feel like it is missing some vital pieces to it, right? Now, the first thing you need to do is identify what the higher time frame structure is by picking a high time frame that lets you read candle closures and lets you read market impulses. So the time frames that I prefer are typically the weekly or the daily time frame. I even go higher than that when I'm looking for really institutional moves that I believe can go for thousands of pips that I want to be able to scale in and trade for like an entire quarter. But the biggest thing you want to start off with is identifying your structure on the right time frame. So you want to use something like the weekly or the daily. So let me give you an example really quickly. Here we are on Bitcoin, because Bitcoin is one of everybody's favorite instruments to trade. Okay, now if you look at this, I'm using all black candles, and one of the reasons why I use all black candles is because it allows me to pay attention to how the market flowed versus paying attention to the bullish and bearish price action that may have happened in the interim. And you'll understand why I do that even on an even deeper level in just a quick second. Okay, so if we think about how the market delivers, okay, if we were looking at a bullish example, we would say the market goes from a low to a high, then a higher low, then a higher high, then a higher low, et cetera, et cetera, et cetera. Okay, now how do we identify this? I think one of the easiest ways to do this is by turning all of your candles one color so that you can just see when the market gets to a high point, and then the market basically gives you this retracement price action, and then of course when the market presses to the upside. And all you really care about is the highest point that the market got to before retracing, and then the lowest point that the market got to before exploding to whatever direction it was going to go to. So in this particular case, we would say that the highest point for this particular bit of price action will be here, where Bitcoin was at 73,700, and then the lowest point is here, right? Now, this is the high, and then this is the low, and then we push up and we break this high. So we would call that a break in structure. This is where a lot of traders would identify this as a BOS, okay? Now, when we break this structure, we have to look to see what's the highest point that the market then got to before giving what we like to call a significant retracement. Okay, now identifying a significant retracement, that's something that you can use your Fibonacci tool for. But once you've gotten used to just seeing it, you'll know that this right here, this is the new high. Okay, right here, that's the highest point that the market got to before giving us the next significant retracement. And as we see, that significant retracement ended right here. Okay, so now as we're reading this, we could say to ourselves, once the market breaks above this high, it should do something. It should pull back and it should give us an entry. Now, I can look at this right here and kind of see that this gave a 23.6 or 38.2 pullback on the fib, right? So if I pull my fib out and throw that on really quickly, let's see if it gave us at least a 23.6 pullback or a 38.2. Right there, 23.6, okay? 23.6 pullback. Some traders enter at that level. I don't love trading at that level, but as you see right there, pulled a 23.6 pullback, and you could have found your buy opportunities in here, trading some nice price action. You see the market pushes up and breaks structure once more, okay? So that is how you identify your structure points. You want to keep identifying when the market breaks structure, the swing point, that lowest point that the market got to before pushing up and breaking, et cetera, et cetera, et cetera. Okay, so we see that we've got, as I zoom in a little bit more just to show you, okay? Look here. So we know we got this breaking structure here, just when the market pulled back, pushed up, broke that structure, pulled back, and we broke that structure again. Okay, so let's go ahead and let's duplicate this breaking structure right here. right? Now, once the market broke this structure with this low right here, we can say to ourselves, if this market is giving us consistent higher highs and higher lows, what's the highest point that the market got to before giving us a significant retracement? Right there, we see a significant retracement right there. That's probably to about 50%, more like 61.8, and that we know is the golden ratio. Look, picture perfect, 61.8 pullback, and we could have got some strong buy opportunities right there, of course, pushing up to attack the structure. So we see once we broke this structure here, right, the market rallied up. What's the highest point that it got to? Right there, before it gave us our significant pullback. Now, if we're looking at this and we're reading this structure, right, the breaking structure, pullback, breaking structure, pullback, breaking structure. Once we identify our consistent structure breaks, we can see that the market has a specific direction. It's bullish. And so we can wait for the market to break a structure and then give us a retracement of some kind. And that is when we would execute our trade, or at least begin investigating where to execute our trade from at the specific Fibonacci levels. I like to use Fibonacci a lot to justify my entries. And once you catch a really nice entry, of course, you're always attacking a structured high or a structured low. And that is the biggest thing right there. So we see that was a nice 61.8 pullback right to the golden zone. We could have placed our buy opportunities there. And then, of course, the market pushes up and takes out that new high and then breaks the structure. So that is step one. Step one is identify your higher time frame structure. Okay. Now, step number two, when it comes to catching your low risk, high reward, big risk to reward ratio trades, is reading lower time frame order flow. Okay. Now, what is lower time frame order flow? So lower time frame order flow, in my opinion, the way it was taught to me and the way it works really well is when you understand your market structure and then you see how the market is delivering price up to the point where it breaks structure and even beyond the point where it breaks structure. Okay. You'll see that order flow really is just a microcosm. It is a lower time frame picture, lower time frame breakdown of price delivery based on the higher time frame. Okay. So I want to go back to using this here. I want to use this leg of structure right here as our example. Okay. So we know that we had this low up to this high, and we would say that this swing low up to this swing right here gave us a retracement of some kind of significant retracement. And I think that was like a 61.8 pullback as well. Okay. That was actually to the 50%. So that's even better, right? Equilibrium pullback. Okay. So let's just say that here we were going to begin looking for our entry once the market came to the equilibrium. All right. And of course, hindsight is 2020. Everybody's, a genius when it comes to reading things that have already happened. I just want to show you guys how you can start to use this. So when you play this game of probabilities, when you are right, you're significantly right. Okay. When you're wrong, you're only wrong a little bit, because we know that chasing high win rates is something that a bunch of YouTube gurus teach you because they effectively want you to blow your accounts, so they only make money by you putting money in their brokers. That's a different conversation for a different day. I want to let you guys and gals know that if you can win somewhere between 25 and 40% of your trades, but your trades have a 1 to 5, 1 to 8, 1 to 10 risk to reward ratio profile, you literally print money. Okay. I've been doing this for 6 years now professionally from home, never had to chase people down to give me money. This is how I make my money. And of course I have a business as well, but again, another conversation. Okay. Anyway, what we want to do is we want to identify first and foremost our structure. So we know what our structure is. We know we are bullish in this market, and we believe we've got a retracement. Now, what we ultimately want to do is we want to target this next structure. That is where we want to break and we want to take the trade off. Okay. But now we need to read the lower time frame order flow, because the lower time frame order flow is going to tell you when the retracement began and when the retracement is likely ending. And when you can understand that the retracement is coming to its end, then the impulsive move that's going to break the structure potentially is about to begin. And that is where you want to take your shot. Okay. So here I'm jumping down, and of course I'll show you how to do this time frame by time frame in other videos and in my courses and in my mentorship. If you join the community, it's all there, right? But I want to jump straight down to my favorite time frame, which is the H1. All right. So now here we are on the H1 time frame. All right. And you notice how we go straight from the weekly to the H1. It's like, man, that's a whole lot of candles now. It's fine. Trust me. After you learn how to read extremes and see these market swing points, it becomes really easy for you to recognize where your opportunities could be. Okay. So here's what I want you to pay attention to. You have to think about how the market traded down into our POI. And our POI in this particular case, our point of interest, is the equilibrium of that trading range, the 50%. So what we want to do is we want to identify how the market flowed down to that point to see if that flow changes in any way. So we want to say that this here, since we already know what that is, that's the high, that's the structured high. Okay. This is our high up here. We want to go ahead and circle that off. And then this was our low. Okay. Now notice we got a low here. It was another higher low in this order flow that was moving to the upside, but we got this low, and then the market pushed up and didn't give us a higher high. It actually gave us a lower high. So we know that something's going on, right? Lower high, then we take out this low here, and we get this lower low. Then we get this lower high, then we get this lower low. So what we effectively see is that the market has changed character. We will call this our change in character here. A lot of people argue and say that's not a change in character, it's just a break in structure. The way I was taught to label things has truly helped me to see the market and know when the market is turning around in order to do something, whether it's a full reversal or just some type of retracement, okay? So this we would label as our change in character. This we would label as our first break in structure. And then we ultimately just want to see how the market continues to deliver after the character has changed and the structure is broken. So let me go ahead and do that really quickly. Okay, so we say high, low, lower high, lower low, lower high, lower low, lower high, because that's the highest point that the market got to before pushing down, breaking that structure right there, and giving us our next lower low right here. Then we got the next lower high right here. We see the market broke down once again and gave us our next lower low right here. This is easy to see, especially again if you use those all black candles or all whatever color candles you want to use, right? So we got this lower low here, then we get this lower high right here. We finally break down and break the structure here, giving us this lower low. Then we see a lower high here, but then we're followed by a higher low. And I'm going to put that in a different color because that's where things begin to get interesting, okay? So we have a higher low here. Notice that this low is higher than the previous low. And so we would say to ourselves, something has very likely shifted here, right? We've got this higher low, and then we know that something's likely shifted because that higher low then presents us with a higher high, changing this character. We then get another higher low presented by yet another higher high. So now that the character has shifted and the structure has broken on the smaller time frame, going back in the direction of the big time frame, we want to start to say to ourselves, can we get into the move, right? This is where we start to identify our order flow has shifted to an H1 bullish order flow, and that H1 bullish order flow is in alignment with our weekly bullish order flow. So that's what gives us one of our best entries, okay? Now, I automatically see some areas that I would like to investigate, okay? This one is something that you'll learn about in my mentorship. It's called a PIBOS, right? The pullback to impulse that breaks a structure. I would like to see if the market returns back to that and gives us that entry. We can have our stop losses underneath and then push up. Or, truth be told, we can just look at this entire area here as an area of demand, and we want to see the market come back into this area of demand, give us a nice strong entry trigger, and then we would take our shot. Now, the market is already, based on what I'm looking at here, the market's already giving us this bullish order flow here, and it's retesting this area of demand. So you could look for one of two entries. You could either look for the market to drive down and tag that PIBOS right there, which would give you an excellent risk to reward ratio trade, or you can look to see if after this demand zone has been traded out of, if there's another smaller demand zone that's going to be respected to give you a really clean entry, okay? And here it is right here. I think this is another small demand zone that I probably would be looking for a trade off of. I would look to see if maybe the market began to give me some bullish engulfing candles and then just have a tight stop loss just underneath that structure. So let's look at this a few candles at a time. All right, I kind of like that H1 bullish engulfing. Let's see if we get a second one. Boom. So right there, that will be enough for me because I believe that the market is trading out of this demand zone here, right? We had that first bullish candle, then we have this second one that's showing a willingness to trade out of this demand zone. So this is where I would look to go long on my position, right? I'd look to go long here, stop loss just underneath that swing. And now if we think about this for a second, I'm targeting higher time frame liquidity. I'm targeting the higher time frame breaking structure, which we identified is way up here, right? This is that breaking structure point. So this is what we'd be looking at. So now you see that right there, that has a 1 to 22 risk to reward ratio profile from that entry. All right. So let's go ahead and let's watch this trade. Now you see here, this is where we got stopped out. Right now, this is a part of the game. And I always like to show this when I'm doing my blind back testing, that I can see a picture perfect area where I would like to enter into the market. And yeah, I'm gonna be wrong, but I mean, this is a 1 to 22 risk to reward ratio profile. So if I'm wrong on this one and I'm right on the next one, it pays for it. All right. So we took a loss right here, but this demand zone is still holding. So what I like to see is if we have a new entry pattern, and I kind of see one here, right? We see that the market gave us a small change of character with a small pullback. So I would be looking to go long on this position. Once again, have my stop loss just underneath that swing point right there, okay? And this entry is actually a little bit better. So we should have an even better risk to reward ratio trade. Let's go ahead and take it all the way up to our target right there, okay? Now this one is a 1 to 26 risk to reward. Cool, I'm willing to take that shot, right? Let's see how the market plays out. Goes into a little bit of drawdown, but doesn't take us out, which is awesome. And now let's see how it begins to trend off. Let's go to a higher time frame, see if it moves a bit faster. Boom, this market is rocketing. All right, here we are in the H4 now. And as we see, this is clearly going our way. This is going really well for us, right? And then what are we targeting? We're targeting that breaking structure price, okay? And I think we can see that this very likely hit take profit, bang, there it is, okay? So we see here, this trade, 1 to 26 risk to reward ratio profile. And yeah, we lost this first position with the 1 to 22. That's okay, it's part of the game, right? We're going to lose trades. Any trader that doesn't tell you that they lose trades, they are lying to you, right? Now, from a 2-trade perspective, I got a 50% win rate. I lost one, won the second one. In this trade here, 1 to 26.5 risk to reward ratio profile from beginning to end. Now, will I hold that trade full volume? Probably not. I'll probably take off a good partial at somewhere like 10 or 15 R, something like that. But ultimately, this shows you that you can, in fact, trade with very high probability entries based on reading your lower time frame order flow. The last part of this, right, because remember I told you it's a 3-step process. First one was identify your higher time frame structure. Number 2 was read your lower time frame order flow. And then of course, number 3 is what you saw me do in real time, which is take the shot with your confirming pattern. Okay, I am a price action trader, so I like to look for strong price action at specific points of interest, right? I look for engulfing candles, something that we traders like to call the 3-candle swing. I tend to look for rally-based rallies and drop-based drops. I look for strong patterns on my lower time frame so that I can say, if this pattern here is the confirmation that the market's ready to move, I'm willing to take that shot. And you got to be okay with taking multiple shots in this particular case, right? Like, I'm not going to tell you that you're going to have a 100% strike rate. No trader does. And again, if anybody tells you that they're winning 70, 80, 90% of their positions, chances are they're only qualifying a win as a trade where they actually took some profit from the market, but the profit that they took isn't as much as the amount of money that they risked. It's almost like saying, like, hey, I'm risking $1,000, but the trade went $200 in a profit, and I closed the trade even though it was just $200 in profit. Well, you risked $1,000. So if you categorize it a win, then fine. I mean, you can't fix stupid, like my mentor used to say. But I'm not going to risk $1,000 and then only take money when I'm $200 in profit. If you do that over an extended period of time, you'll start to see that even if you have a quote unquote high win rate, the losses will eat all of your wins. That's one of the reasons why you see traders who have 70, 80, and 90% win rates when they look at their funded challenges and things like that, but they're not passing challenges. They're losing money, and they wonder why they've got such a high win rate. It's because their risk-reward profiles are working against them and not for them. This right here lets the risk-reward ratio profiles work for you, okay? Now, this was a swing trade. This was massive. But the same way you can see this on the weekly time frame and the scale down to the 1-hour time frame, there are trades that I've taught my mentees how to take where you have a weekly time frame point of interest, and then you have a shift in order flow on the 5-minute time frame, and you can execute a trade that has a single-digit stop loss and a triple-digit take profit. And this is something that I do live inside of my community, and I do it live 3 days a week in front of people with real capital, real funded capital, and I have traders who are making tens of thousands of dollars on a monthly and weekly basis because this is what we do at a very high level. So this is what I wanted you guys and gals to understand. This is the 3-step process that I follow personally and that I teach to every single one of my students so that you can catch these big trades that go for big RR, and then of course, lose some, win some, have the outcome still be income, and you still will show up on top. Hopefully you found some value in this video, and hopefully you use this to pass more challenges, to win bigger profit withdrawals, and get on the funded trading leaderboard. And if you'd like to know exactly the 5 magic numbers that I recommend so that you can consistently earn at least $12,000 per month as a Forex trader, then you probably want to watch this video right here.